everyone. I'm Krishna Karwa, a senior research analyst with iFAST Financial India Private Limited. In this video, we will touch upon the nuances of passive investing in debt. And to know more about this, I have with me on the call Mr. Niranjan Avasthi, who is the head of product marketing and digital business at Edelweiss AMC. We look forward to his insights during the course of this conversation. So hi Niranjan. At the outset, yes, Edelweiss has been among the names that launched passive debt funds much earlier than the rest, and I'm referring to Bharat bond funds and ETFs more specifically out here. Why do you think there is a lot of interest around this space, particularly at this point in time?
Thanks, Krishna. Thanks for the introduction, and thanks for having me on this session. Yes, Edelweiss Mutual Fund has been the first player in the Indian mutual fund industry to start the passive debt journey, specifically launching the first debt ETF alongside the Bharat Bond ETF program, which is a joint program along with Government of India. Now, when we launched this, Bharat Bond ETF somewhere in December 2019, the actual work started much before that, almost a year before that, and we spent a lot of time on researching about what is the right structure, how do you want to launch this ETF, because globally open-ended debt ETFs were large enough. However, a target maturity structure kind of ETF or index funds were just being launched or were just about to getting started in the Western or developed world. So from there, actually, we thought what could be the right structure for India. Looking at the Indian investors, if you see, traditionally Indians have invested into fixed deposits, and what you get in fixed deposit is are two important things. One is you get a fixed tenure, which is whether your money will be fixed for 3 years, 5 years, or 1 year. So there is a fixed tenure. And the second thing is how much return you get. So somewhere, if we can try to address these two needs of the investors, we thought then getting a right ETF structure in India would be possible. Basis that, we launched our first Bharat Bond ETF in a target maturity structure, and we'll talk in more detail about this structure. But this is how we found out the structure, and then post that, definitely we've seen many other launches on the passive side. In fact, one of the objective of Bharat Bond ETF program was to create an ecosystem and get the debt passive space started, so that more and more players come and start launching debt ETFs or debt index fund, so that retail participants can move into debt mutual funds and not just fixed their portfolio into FDs and other traditional avenues. So that's how the evolution started, and here we are in over the last 1.5 to 2 years journey.
Absolutely, Niranjan. And as you alluded to the fact that this is a worthy alternative to fixed deposits, which of course happen to be very popular among retail investors. And given the a definite timeline and the probable return expectation, I think that should really help address a lot of uncertainty related concerns for a lot of people.
Right.
So Niranjan, since Bharat Bond ETFs were among the first set of products that Edelweiss launched, we'd like to understand the key features of the same. So can you take us through that?
Right. So as I mentioned, target maturity is a very different and unique structure. As I mentioned, traditionally in India, people have been, when they talk about fixed income, the fixed word is very fixated in everyone's mind. They want return which are fixed, right? And fixed deposit is the first option which a lot of people can think of. Now, how to declutter that and how to get investors into a debt ETF, which is a very new product in India. And that is where a target maturity fund or an index fund or a ETF fits in. Target maturity ETFs or index funds have basically 3 to 4 important characteristics. One is it has a defined maturity. So target maturity index funds can come in 3 years, 5 years, or 10 years. So they have a defined maturity. They invest bonds which have similar maturity. Second thing is, because it has a defined maturity and because it follows a bond-like structure, there is slight amount of visibility of returns. When I say visibility of returns, which means today if you're investing in a bond which is trading at maybe 8% yield or 8% YTM as we call it, and you hold that bond till maturity, unless the bond defaults, there is a high amount of visibility that you will earn that 8% returns. The same structure we have bought into this target maturity index fund, wherein a portfolio of bonds are being held and they are held till maturity. So anyone investing in this index fund or ETF, on that day, whatever is the YTM, there is a fair amount of visibility that this is a kind of return which he can expect. Of course, because it is mutual fund, returns are not guaranteed. There is a credit risk element as well. But if you stay invested till maturity, there is no credit risk. There is a certain amount of visibility of return. So this is the second most important feature. Now, because they come in an index or a passive format, there is a lot of transparency as well. So you know where the ETF, where is the portfolio being invested. It cannot go beyond this. So if it is Bharat Bond ETF, you know it is all AAA rated PSU bonds. It cannot have a AA rated corporate bond or any other bond which is not a part of the index. So there is a fair amount of transparency. Costs, of course, because it is passive, costs are very, very low. And in a debt mutual fund or debt investing, costs are very, very important, because even 10 basis or 15 basis point here or there is a large amount of your overall returns. So these are broad features. And of course, because it is in a mutual fund structure, there are indexation benefits. But specific to a target maturity structure, just to summarize, it has a defined maturity. Because it has a defined maturity, there is a certain amount of visibility of returns if you stay invested till maturity. There is a transparency of where the portfolio could be invested, what cannot be part of the portfolio. And lastly, it is a low cost vehicle. So these are kind of very, very important feature of this product structure.
So essentially, it's the central public sector enterprises that are issuing these bonds in conjunction with Edelweiss.
Yes, yes.
And hence the name Bharat Bonds.
Absolutely. So this is basically a Government of India program for which Edelweiss have got a mandate to structure, launch, and manage these ETFs. The name was decided by us as a Bharat Bond ETF program. And as you rightly pointed out, the underlying will all be AAA rated PSU public sector entities, which will be part of this portfolio.
Absolutely. So moving on, talking about the underlying index, we are curious to know as to how would it be constituted, and what would the maximum exposure to a particular PSU or a sector be?
Because this is a passive vehicle, the underlying index becomes a very important part, and it is very important to understand. Thanks for that question. So if you see, this index is based on certain factors, is created based on certain factors. One is, of course, it will have a defined maturity, because the overall structure will have a defined maturity. Index also will have a defined maturity. In case of Bharat Bond 2030, which we had launched in December 2019, the maturity date of the index is April 2030. Now, coming to the constituents will be AAA rated all public sector enterprises who have outstanding or who have any bonds maturing between 12 months preceding the maturity date. So for example, XYZ AAA rated PSU has a bond issued in the market or an outstanding bond which is maturing between April 2023 29 till April 2030 will be part of 2030 index. All these bonds which have maturity in that segment will be part of that index. The weights to each of these constituents will be based on their outstanding. So if NTPC has 10,000 crore outstanding out of total 1 lakh crore of entire portfolio, it will have 10% weight and so on. The cap to each of the constituents is maximum set at 15%, and this is as per the ETF regulation issued by SEBI. Minimum can be 0 if there is no outstanding, maximum can be 15%. And all these number of bonds are weighted according to their outstanding, and a portfolio of indexes created. This index is rebalanced on an every quarterly basis. If there is a new issuer which needs to be added, gets added. If there is a downgrade and any of the CPSC doesn't qualify to be a AAA, then it gets out, and so on and so forth over a period of the entire maturity till the maturity. This is how the index gets rebalanced and maintained.
That's in fact quite reassuring, especially from a credit risk perspective, because in the past there have been incidents that have not gone down too well with the investor fraternity, and the fact that it's issued by AAA rated issuers and more importantly have a definite timeline can give investors a fair bit of comfort about the places where this money is getting deployed.
Right.
So Niranjan, at this point in time, for which time series are Bharat Bond ETFs available, and what would the tentative yields be if one were to invest a lump sum right now?
So if you see currently Bharat Bond ETF spans across 4 different maturities. Basically we have Bharat Bond ETF 2023, then we have 2025, then we have 2030, and then we have 2031. So these are 4 points on the yield curve, 2 on the shorter end and 2 on the longer end. One is in fact in the mid range, which is 2025. The YTMs as on yesterday on these ETFs are so 2023 is yielding somewhere around 4.60%. 2025 is yielding somewhere around 5.43%. And 2030 and 31 are trading in the vicinity of around 6.75 to 6.78 respectively. So that's broadly how the YTMs are spread across the yield curve and across these 4 ETFs currently.
Okay, so a good set of options then for investors with a specific time horizon to take these into account.
Right.
Okay, so another important point here is that Edelweiss is also coming up with a fund which focuses on PSU bonds and SDLs, and this particular index fund matures in 2026 apparently. Can you elaborate on the characteristics further, please?
So we are coming up with a new series in 2027 bucket. We already have a 2026 PSU plus SDL index fund. So both these index funds are basically following the similar strategy which I just mentioned for Bharat Bond ETF, which is a target maturity strategy. And so talking particularly about 2027, which is the new one which we have launched and currently the NFO is going on. It is basically a portfolio of AAA rated PSU bonds plus HDLs. 50% of the portfolio will be into AAA PSUs and remaining 50% will be into HDLs. And it has a maturity, as I mentioned, maturing in April 2027. All bonds which are maturing near to this maturity date will be part of this portfolio and it will be held in maturity. Currently, the index yield of this portfolio is close to 6.15%. As I mentioned, the features for Bharat Bond ETF, the similar features stand true for this index fund as well. And the only difference in index fund and ETF here is if you want to invest in index fund, you don't need to have a demat account. You don't need to go and have a trading account or trade on exchange whenever you want to buy or sell. Index funds are akin to mutual funds. You can buy, invest online through AMC portal or any other portals which allows you to invest in mutual funds. You can set up SIPs. That is the only difference. Otherwise, the overall structure of this index fund remains similar to Bharat Bond ETF. The other difference is in terms of portfolio, where we have 50% into SDLs as well, as far as index is concerned.
So the index fund can complement the existing suite of Bharat Bond ETFs for people who want to follow the SIP route, which is quite popular.
Right.
Okay, and Niranjan, what about the expense ratios for both the Bharat Bond ETFs as well as this 2027 fund that you spoke about?
So if you see Bharat Bond, because it is a Government of India program, it comes virtually at a zero cost. The expense ratio is 0.005%, which is virtually almost zero for all the ETFs of Bharat Bond. For index funds that we have, which is 2026 and 2027, broadly the expense ratio range in direct plan is close to 15 basis point, and in regular plan will be close to 30 basis point, plus minus taxation which is there. So roughly this is the range of expense ratio in these two index funds.
Right. And another important point here is that there is a lot of nervousness about interest rate risk now coming into the picture. So given this uncertainty and the volatility one can expect in NAVs, do you reckon passive debt funds can be a good addition at this hour?
So it's a very important question, and people have been talking about interest rates rising for almost a year now, and we have only seen interest rates being stable even on the longer end curve and even on the shorter end curve, apart from 20-30 basis point here and there. If you look at the yield curve today, and we just discussed the YTMs of different Bharat Bond, if you notice 2023 is trading at somewhere around 4.6, and 2030, which is the 10-year segment, is trading somewhere around 6.7 or closer to 7 if you say so. If you see, typically right now the yield curve is quite steep. The difference between the short-term rate and long-term rate is very, very high. Now, if someone wants to take advantage of this, one way is by locking in your money, if you have that much of investment horizon, on a longer end yield curve and lock in those yields. And target maturity structure gives you that ability. And if you lock in your yield today, and if you're going to stay invested till end of the tenure, even if interest rates rise or fall, you're not going to get impacted. And that's the beauty of the structure. Even if interest rates were to rise from here, at some point in time, if you want to invest more, you can invest more on these products and average out your entry point. But if you have a good investment horizon of 3 years, or which is matching to the maturity of these funds, there's absolutely no worry. There's a fair amount of visibility of returns, and you can invest. At the same time, even if you believe that interest rates were going to rise, because the yield curve is very, very steep today, most likely the impact of rising yields will be more on the shorter end of the curve, because RBI policy rates today it's around 4%, and long-term yields in the corporate bond, even GSEC is trading at 625, which is 225 basis point above repo rate. Now, even if RBI were to raise rates by 1 percentage points on a long-term basis, a spread of almost 150 to 125 basis point on a 10-year over repo rate is an average spread which we have seen over a period of time. So there is fair amount of margin of safety if you're getting into 7 to 10 year kind of investment product or point on the yield curve. So I don't think so people need to worry about it. What they can do is, of course, spread out their investments across the yield curve, and that's again an important usability of these products. So if you believe that interest rate is going to rise, you can spread it up across shorter term as well as longer term. So you can invest in 2023, 2025, At the same time, some amount of your portfolio you can invest in 2030 or 2027, where the yields are higher.
Yes, that was quite comprehensive. And an important point here is that you can eliminate risks but if you stay invested
Absolutely.
till maturity.
Absolutely.
And one question that a lot of investors might have here is we've been hearing this debate about passive versus active. So more specifically, in the context of debt, how different are these passive funds versus active ones? And how can investors position these funds with predefined maturities in their portfolios?
Right. So there are two questions which you have. Let me take the first one, which is active versus passive. And this is a heated debate, right? And unfortunately, for a lot of people, active versus passive is only about alpha over between over the benchmark, whether active delivers alpha over the benchmark or doesn't. And second is cost. But active and versus passive is also much beyond this. Now, if you see specifically in debt segment, the products which are coming up in passives are all target maturity products. Now, that kind of product is not available on the active segment. Of course, there are some roll down products which are there and people are investing in them, but largely most active funds are open-ended, are in the open-ended format, and there is an element of duration risk. Compared to that, when you come to passive debts where the target maturity segment exists, there is fair amount of visibility of return. Now, second important aspect between passives and active is passives offer you a lot of transparency today. And what we have seen in Indian debt mutual fund market over the last 2-3 years, a lot of people are worried about what is in the portfolio, what is the quality of the portfolio, because a lot of people have burned their fingers getting into wrong portfolios with very, very different expectations. So passive solves that problem as well. There is utmost transparency, what is there in the portfolio, but also what can be and what cannot be in the portfolio. So that is a very important advantage of passives today. And of course, cost is an important element, and more so in a debt segment, because in equity, a 10 or 15 basis point or 20 basis point doesn't make a difference, because in active, if you outperform passive, that can make up over a long period of time. However, in debt, even 15 to 20 basis point is much, because it is the YTM which you are earning, and more so when interest rates are low today. So cost definitely is again an added advantage between passives and active. So I would say look at transparency which passives are offering, look at the structure which passive is offering, which active funds are not offering today, which is target maturity. And lastly is the cost. Even in active, the costs are low, to be very honest, but that is again is an important aspect which you get in passive funds.
And how should investors be positioning these funds with predefined maturities?
Right. So that's your second question. How should investors use? Now, there are multiple ways to use target maturity. One very basic rule is just match your investment horizon with the target maturity segments funds you are getting into. If you have a 10-year money today, you can definitely go and invest in a 2031 target maturity fund. If your money is for 5 to 6 years, you can definitely select 2026 or 2027 target maturity index fund. Now, the second question is, if you don't have any defined investment horizon in mind, what's the strategy? In that way, what you can do is you can spread out or ladder up your investment across the maturity. So you can invest some amount in 2025, 27, and 2031 or 2031. And as they mature, you keep on rolling. So this way, one is you can create a portfolio on your own by having short-term, medium-term, and long-term ETFs. You can also match your investment horizon with the maturity of the target maturity fund. That way you get a FD kind of experience. So these are basic two ways in which you can use this fund. The third way is, of course, if you're creating your retirement corpus, you can select a longer maturity fund and keep doing SIPs and keep, saving in that. So these are a couple of ways in which you can have or add these funds in your portfolio.
Okay, Niranjan, I think you've touched upon all the relevant concepts in the context of this particularly important and growing trend. So, in addition to what we've discussed and talked about, any other concluding points that you would like to express?
Right. Yeah, I think so. It is very important to have uh, debt mutual funds in your portfolio because they are very, very tax efficient. Uh, of course, because of what has happened in last 2-3 years, some retail investors or HNI investors uh, do worry about how to select a debt mutual fund, how to look at the portfolio quality. If that is your worry, then actually passive target maturity index funds are right for you. They are DIY kind of instruments. Even distributors investing on their or suggesting their investors, it's very easy for them to use these funds and create a nice portfolio. uh, I think so. That's what I can say at this point in time. Thank you so much for having me, and great answering those questions from you.
Thank you very much, Niranjan and Edelweiss AMC, for taking out time and discussing about these products at length. I'm sure a lot of viewers will find these takeaways useful in terms of their decision-making process. So on that note, we shall wrap up this video. Once again, thank you everyone for joining in, and we shall connect with all of you pretty soon. Until next time, take care, stay safe, and stay invested.